Welcome to FIN4443, Financial Policy and Strategy. This is part 1 of our Week 1 live chat series. In our time together, we're going to dig into how companies make high-level financial decisions, things like investments, capital structure, and valuation. Whether you're planning a career in finance or just want to make smarter business decisions, this course will help you think more strategically about money. I'm Dr. Mark Dennis, and I will be your professor throughout this course. I've been teaching online business finance courses for Keiser University for over 15 years. My degrees include a doctorate in business administration, a master's in personal financial planning, and a bachelor's degree in computer science. I'm also a certified financial planner professional with many years of experience in the fields of securities brokerage, insurance, banking, and of course, teaching. Let's kick things off with a little housekeeping. Make sure you've introduced yourself in the discussion board this week. This is our way of building a learning community. Don't forget the Academic Honesty Certification. Yes, it is required. Also, there's a pretest waiting for you. The pretest will not count towards your grade now, but you will see it again in week number 4 as a post-test that does count as part of your final grade. So treat this as a good warm-up. Here are some things you will be able to do by the end of this course. We're going to build your skills in reading and interpreting financial statements, income statements, balance sheets, and cash flow statements, for example. Then we will layer on some financial ratios and analysis tools to help you understand how a company is really performing. By the end of the course, you'll be drafting cash budgets and forecasting financials like a pro. We'll also explore how things like interest rates, inflation, and dividends affect financial forecasts. Expect to get hands-on with working capital, cash management, and how to calculate returns using things like future value and internal rate of return. Don't worry if math isn't your thing. We're going to break it down step by step. And finally, we'll talk about the big picture. This includes how to calculate required returns, what influences company valuation, and even how inflation impacts cash flow. We'll also look at how global topics like currency exchange rates come into play. Let's take a moment to review some basic concepts from Chapter 1. So what exactly is finance? At its core, finance is about decisions involving money, how we raise it, how we use it, and how we manage the risks that come along with it. You'll hear me say this quite a bit. More money sooner and with less risk is always better. That's the foundation of financial decision making. In general, the world of finance includes these categories: financial markets and institutions, investments of all types, financial services, managerial finance. As we dive into corporate finance, it's important to understand how businesses are structured. There are 3 main types: proprietorships, partnerships, and corporations. Each one has pros and cons, particularly when it comes to liability and taxes. Let's take a closer look at each of these. A sole proprietorship is the simplest business type. Just one owner calling the shots. It's easy to set up and easy to operate, but there is one downside. If something goes wrong financially, the owner is personally liable. That means their personal assets, in addition to the business assets, may also be at risk. A partnership is like a proprietorship, but with more than one owner. This setup can raise more capital, but the risks are also shared. And disagreements between partners, well, that can make things more than just a little messy. Corporations are a whole different ballgame. These are legal entities separate from their owners, which means limited liability, and that is a huge plus for the owners. Corporations can also raise money by issuing stocks and bonds. The downside to this, though, is double taxation and higher regulatory costs. Here's a fun fact. There are more sole proprietorships and partnerships in the United States than corporations, but corporations produce the majority of goods and services. Why is this? It's simply because they scale more easily, and corporations can raise huge amounts of capital. In addition to providing limited liability protection for owners and the relative ease with which corporations can raise capital, there is another significant advantage to the corporate form of business. Ownership in a corporation is very easily transferred via the sale of shares of stock. As a result, valuations are relatively easy to compute, and investors are generally willing to pay more for shares of ownership in a corporation. When we talk about corporate goals, there's one that stands above the rest: maximizing stockholder wealth. And yes, that's essentially the same thing as saying increasing the company's stock price. It may sound a bit capitalistic, but this goal keeps the business accountable to its owners, the shareholders. Now, how do we get there? This is done through incentives that align managers' goals with those of the shareholders. If the stock does well, managers often benefit too, in terms of bonuses, stock options, or performance-based pay. At the same time, social responsibility is increasingly part of the conversation. Companies that treat their employees well, reduce their environmental footprint, or give back to the community can enhance their reputation, and that can also create long-term value for shareholders. So while stock price is the main scoreboard, it's not the only one worth watching. So how does management increase shareholder wealth? There are three main ways: deciding how much debt to use, what investments to make, and how much to pay out in the form of dividends. These choices can dramatically influence the value of a firm. Managers also impact stock prices through their influence on projected cash flows, the timing of those cash flows, the level of risk, and the company's use of debt and dividends. It's a bit like steering a ship. Every decision affects the direction and the speed of progress. Corporate governance refers to the rules and policies companies follow to stay accountable. After the scandals of the early 2000s, the Sarbanes-Oxley Act, or SOX for short, forced executives, especially CEOs and CFOs, to personally certify financial statements. That's a huge responsibility, and it includes legal consequences if they get it wrong. In Chapter 5, we explore the cost of using leverage, specifically the influence of interest rates on business finance decisions. Now we're shifting into the topic of interest rates, often referred to as the cost of money. You'll see how rates are determined and why they matter so much for financial planning, investing, and borrowing. Obviously, borrowing at lower rates is preferable to borrowing at higher rates. But what shapes the movement of interest rates over time? This visual captures one of the most fundamental principles in finance, the relationship between risk and return. The yellow area at the bottom represents the risk-free rate of return. What an investor could expect from a virtually riskless investment like a U.S. Treasury bond. Now, once we move beyond the risk-free zone, investors expect to be compensated for taking on additional risk. That green section, labeled Premium for Risk, shows how the return needs to increase as the level of risk also increases. In other words, no one is going to lend you money or invest in your company unless they believe they're going to be rewarded in accordance with the amount of risk they are taking. You can think of this as the investor's way of saying, if you want my money and there's a chance I might not get it back, then you need to pay me more for taking that gamble. This is the essence of pricing risk into interest rates and expected returns. Let's take a closer look at what goes into an interest rate, or more broadly, a required rate of return from an investor's perspective. We start with the risk-free rate, which reflects a baseline return you would expect from an investment that has virtually no chance of default. A good example would be a short-term U.S. Treasury bill. But in the real world, most investments are not risk-free, and that's where the risk premium comes in. The risk premium is made up of three components. DRP stands for Default Risk Premium. This compensates investors for the possibility that the borrower might not repay the loan. A company with a shaky credit rating will have to offer a higher default risk premium to attract investors. LP stands for Liquidity Premium. This reflects how easily an investment can be converted to cash without losing value. Publicly traded stocks and government bonds are considered to be highly liquid, but something like a small business loan or a rare collectible would carry a much higher liquidity premium. Those are simply more difficult to convert back into cash. MRP is the Maturity Risk Premium. The longer the time to maturity, the more uncertainty investors face. Think about inflation, interest rate changes, or general market volatility. To offset that risk, investors expect a higher return for tying up their money over the long term. So when you see a quoted interest rate, or the variable R in this formula, it's really a combination of the base risk-free rate plus all of these individual premiums that reflect the real world risks of the investment. Next, we shift into the world of bonds. One of the key ways companies raise capital through debt instead of equity. In this chapter, we explore the different types of bonds, how they're related, and how investors determine their value. Understanding bonds is critical because they represent a large part of the financial markets and often make up a bigger portion of both individual and institutional investment portfolios. We'll also look at how interest rates affect bond prices and what risk factors investors should consider when deciding whether a bond is worth buying. Bond ratings give investors a quick snapshot of how risky a bond is, specifically the likelihood that the issuer will default on its payments. The two main players in this space are Standard & Poor's, S&P, and Moody's. These are credit rating agencies that evaluate the creditworthiness of corporate and government borrowers. They do this by analyzing a borrower's financial health, cash flow, debt levels, and overall ability to meet future obligations. They also consider broader economic conditions and industry trends. The result is a rating that ranges from AAA in all caps or the other AAA, using lowercase, for the safest bonds, all the way down to a rating of D, which typically means the issuer is already in default. When a company issues bonds, credit rating agencies assess the risk of default. Ratings like AAA or AA suggest low risk. Most institutional investors can only buy investment-grade bonds, so the rating really matters if a company wants to raise money. Investment-grade bonds are considered safe enough for institutional investors, like pension funds or banks, to hold. Below that, we enter the world of junk bonds, which carry higher risk but also offer higher potential returns. So in short, the better your rating, the cheaper it is to borrow money. But if your rating drops, the cost of capital goes up, sometimes significantly. To figure out what a bond is worth, we use the basic valuation model shown here. The idea is pretty straightforward. A bond's value equals the present value of all of the future cash flows the bond is expected to generate. Those cash flows include periodic interest payments, also known as coupon payments, and the lump sum principal payment you get back at maturity. Each of these future payments is discounted back to the present using the bond's required rate of return, which is labeled here as lowercase r. The further out a cash flow is, the more it gets discounted. That's because money today is worth more than money tomorrow, a core concept in time value of money. So the total value of the bond is just the sum of all of those discounted cash flows. If the required rate of return changes, perhaps due to changes in interest rates or credit risk, this will directly affect the bond's price in the open market. This formula is how we calculate the present value of a bond, and it's a direct application of the time value of money principles. It has two main components. The first part calculates the present value of the bond's interest payments, those regular coupon payments you receive every period. That section uses the present value of an ordinary annuity formula, which is what you use when you're receiving equal payments over time. The second part of the equation is the present value of the bond's face value or maturity value, what the issuer promises to pay at the end of the bond's term. This is calculated using the present value of a lump sum formula, since you receive that one-time payment all at maturity. The variable R sub A is the required rate of return, also known as the discount rate. It reflects what investors expect to earn based on the bond's risk. If interest rates rise, the discount rate increases and the bond's value falls. If interest rates fall, on the other hand, then the bond becomes more valuable. This formula gives you a precise way to assess whether a bond is a good investment at its current market price. Here we see how to calculate a bond's yield or total return to the investor. There are two parts to this return. The first part is the current yield, which is calculated by dividing the annual interest payment, labeled here as INT, by the bond's price at the beginning of the year. This tells you how much income you're earning from the bond as a percentage of what you paid for it. The second part is the capital gains yield, which captures the change in the bond's price over time. Specifically, it's the difference between the bond's value at the end of the investment period and its value at the beginning, all divided by the beginning price. If the bond's price increases, you'll have a positive capital gain. If the price drops, you could experience a capital loss even though you're still receiving interest payments. Together, These two components make up the total return on the bond, also known as the yield to maturity if you are holding the bond to the end and reinvesting interest payments at the same rate. This is an important measure because it reflects both the income you earn and any price appreciation or depreciation over time. Chapter 7 explores the world of equity financing in the business world. Now we move into stocks. Equity, or stocks, come in two main flavors: preferred stock and common stock. Preferred stock behaves a little like a bond, with fixed payments, but it doesn't have the same legal protections. Common stock, on the other hand, offers both ownership and voting rights. Preferred stock comes with some unique features, like cumulative dividends and priority over common shareholders when it comes to payments. But keep in mind, preferred stockholders usually do not get voting rights. Let's continue breaking down some of the key characteristics of preferred stock. First is priority to assets and earnings. If a company runs into financial trouble or is being liquidated, bondholders get paid first, but preferred shareholders come next, before any common stockholders see a dime. When it comes to dividends, preferred shareholders must also be paid before common shareholders. However, their dividends are not guaranteed in the way interest on debt is guaranteed. Next, we look at control of the firm. Preferred stockholders typically do not have voting rights. This means they usually do not have a say in corporate matters like electing the board of directors or approving mergers. This is a key distinction from common shareholders who do have those rights. Finally, there is the issue of convertibility. Some preferred stock comes with the option to be converted into common shares. This feature can be attractive to investors because it offers the stability of fixed dividends now and the potential to participate in stock price appreciation later if the company does well. Preferred stock sits in a kind of hybrid space between debt and equity. It has features of both, which makes it a flexible tool for both corporations and investors. Common stockholders are the true owners of the company. They get voting rights and potential for dividends, but they're last in line if the company liquidates. It's riskier, but also offers greater upside potential. This slide highlights some key rights and limitations that come with being a common stockholder. First, there's the issue of priority to assets and earnings. Common shareholders are last in line. That means if a company goes bankrupt or is being liquidated, bondholders get paid first, then preferred shareholders, and only then, if anything is left, common shareholders. The same rule applies to dividends. Common stock dividends can only be paid after the company has met all of its debt obligations and paid any preferred dividends. Next is control of the firm. Common stockholders play a critical role in corporate governance. They have the right to vote on important matters, like electing the board of directors and approving major business decisions. That voting power gives them influence, even if they're last in line financially. Finally, we have the preemptive right. This is a protective feature that gives existing shareholders the opportunity to buy additional shares before the company offers them to new investors. This helps prevent dilution of their ownership percentage whenever new stock is issued. These features make common stock both an opportunity and a risk. You have upside potential and a voice in corporate affairs, but less protection if things go wrong. Sometimes companies create different classes of stock, like Class A and Class B, to give founders of the company more control. Founders' shares often come with special voting privileges to retain decision-making power even after going public. That wraps up part 1 of our Week 1 overview. If you have any questions or want to talk through a concept, don't hesitate to reach out. Send me an email, post in the Ask Questions discussion board, or join the next live session. In the meantime, I'll see you online.